everybody. Welcome to FEI Freight Executive Insights. I am not the freight executive with the insights, but I do have the leading advisor and investor to supply chain. It's Mr. Benjamin Gordon. He is managing partner and CEO of Cambridge Capital, if you don't know. I've known him for a number of years. I consider him a good friend of mine. He considers me somebody he might run into in the street and say hi, I think, something like that. Anyway, doesn't matter. Welcome to the show, my friend. How are you?
Great to see you, Michael. I would definitely say more than hi on the street.
I understand. Yeah, there might be a few choice words that, well, we could say them here. This is a podcast. We're allowed to say whatever we want, aren't we?
I mean, who's going to stop us?
I don't know. I don't know. I don't know who would stop us. I have the slightest idea. It's an interesting time right now, and I've talked to a lot of freight executives have several different opinions about why we're in this deeper trough and why there's not this mass exodus of capacity to keep up with the recession of freight. And I'd love your opinion on what's going on here, Ben.
Well, look, we have 9 portfolio companies in supply chain, so I have a few data points for what's going on. You asked how things were going, and I'm reminded of the old expression: in a word, good, and in 2 words, not good. And the reality is, look, we're doing great. Our portfolio is doing great, and looking forward to an exciting year. But this has been a challenging time for everybody in the freight business, and I think there are a few key pieces. One is, you alluded to what's happening in the freight cycle, and freight rates peaked February of 22, and they've really dropped about 50% since then. Seem to be bottoming out, starting to come back up. We see that we have couple of freight companies, freight and logistics companies, BOA and Everest. We have a couple of companies in freight and analytics and data, Green Screens. The data suggests that things are starting to get better.
Good.
And so that's a good sign, number one. And I would point to a couple of things. One is freight rates themselves. 2 is the stabilization. The exits of capacity, which are still probably less than they need to be, but more than they were at this time last year.
Right.
And then third is the psychology. So look, bottom line, I think things are starting to improve. The other thing that I would say, Michael, is when you look at the performance of companies in this arena, it's interesting. Last year, if you were a freight, logistics company, truck brokerage company, and you were down, 40%, 50%, that was in line with market. So if you were down less than that, you were winning. And now, look, we're starting to see some growth. Our companies, Everest, for example, just had a board meeting, and numbers are up, year to date versus last year, and I think that's reflective of both their performance and their good decisions, as well as the market conditions. So,
that's
look, I think for a number of reasons, I think things are starting to get better.
Yeah, that's encouraging. It's interesting when they look at it. So, like last year, the downward trends, right? I saw people, and quite notably from large companies like Brown, like UPS, right? Hey, we're down 30% from last year. I'm like, well, okay, duh. Is that why is that in alarm bells? Hello, it was like, the most anomalously high years ever. So if you're down from those, but still up from 18 or even 19, then that's pretty good, because 19 was a crappy year and 20 was not shaping up to be very good before the shutdown, right? It was, I remember, they were talking about rate floors for, in trucking, right? and all the brokerage houses were screaming, hey, we're going out of business in January of 2020. And then things quickly changed, as we know. But right now, when you look at that data and you see that it's encouraging, are they the same data points that you look at before, or has nearshoring, friendshoring, or the precise data and the proliferation of the need and gathering of that data kind of changed or made your predictive modeling through those data points more accurate?
Yeah, so there are some things that are different now. It's not all apples to apples. And like the joke about the guy that drowned in a river that was an average of 6 inches deep. You can play games with what data snapshots that you take.
Sure.
what I look at, I mean, look, a few things. One, I look at the kind of the overall basket of data for for truckload in particular. Look at it for LTL, can look at it for other modes. Two, I look at it for point to point where there's some consistency, right? I mean, LA to Chicago is a consistent lane, so you have a little more precision that way. Three, um, I also look at the kind of the differentiating from the average versus the little pockets of opportunity. I mean, we all know that, for example, cross border, as you put it, nearshoring, friendshoring, the fact that Mexico has supplanted China as the U.S.'s largest trade partner, so there's more trade activity there. So, looking at and actually there's been consistent growth even through the freight recession in U.S. Mexico. The issue is how much growth at what rate, and is it enough to
Yeah.
offset everything else? But the one other thing that, Michael, I think is worth noting, we are awash in data, and it's interesting to note that, I mean, I had this conversation with somebody where we were talking about the fact, I pointed out that this is the worst freight recession in history, and he said, "Well, how can that be?" I said, "Well, we have really good data since 1980." And he said, "Well, what about before 1980?" I said, "Well, guess what? Believe it or not, before 1980, there was no such thing because prices were fixed. They were set by the government. It wasn't
Yeah, it's
until."
regulated.
Exactly. So we may talk about politics and the impact on transportation and logistics. The least the least likely thing that you could say is that Jimmy Carter was responsible for deregulation in transportation. It seems insane, given that it's the exact opposite of everything else that he did.
Yeah.
But yeah, deregulation in 1978 through 1980, whether it was in trucking, railroads, airlines, you name it, is what allowed us to have variability in pricing instead of the government fixing the rate. So on the one hand, that's great because it created all this opportunity, right? I mean,
Sure.
truck brokerage as an industry wouldn't exist if you couldn't price discriminate between good lanes and bad, where you're going into a market where there's likely to be backhaul or not. But on the other hand, prices wouldn't have plunged like they did in the last 2 years. So, I think that's the reality. We are awash in data and we are awash in volatility. Mostly, that's a good thing, but the pain of the last 2 years illustrates that it's not always a good thing.
Yeah. It appears to me that it's a good thing if everybody's paying attention, right? And realizes that winter comes every year. It's like a season that happens annually, right? And I use that as a cycles in trucking because it always seems like we forget that. Wait a minute, it's going to come back down, and so irresponsible growth, I'll say, happens and causes the next cycle to react, right? So, like how you react in this cycle as an industry sets up how big of an impact the next cycle might have. Would you agree with that kind of statement?
Yeah, definitely. I mean, look, the trough of 2019 led to the boom of 2021, 22, which led to the trough of the last 2 years. And of course, I mean, it's funny.
Yeah.
Mike, I'll tell you one other interesting thing about that. Some industries we thought just always went up and they weren't cyclical. And then what happened was we realized that as they succeeded and their market share got bigger, they became subject to the laws of the cycle. And a great example of that, first company that I started, Threeplex, was a SaaS TMS company 25 years ago. And,
Hmm.
up until that point, well, not just transportation, but software as a whole had gone up just about every year for the prior 20 years. So what
Mm.
happens in 2021? 2021, excuse me, 2001, we have this recession. Really, it started in April of 2000. But software recession of 2001, 2002. And what happened was, and one of the venture capital firms in Boston that I got to know well showed me this graph, and he said, "Look, capital goods, there's a predictable cycle, right? So if you've got big industrial machinery, if you're like John Deere, Caterpillar, you're up in good times, down in bad times. Well, it turns out that software and technology as a whole is a part of the capital goods arena, but it was such a tiny percentage of market share that nobody realized it. And there's been such tremendous growth in software that all of a sudden, by around the year 2000, 2001, it had gotten too big to not be subject to the cycles. Well, that's the exact same thing that's just happened with freight brokerage, When freight brokerage
Mm.
30 years ago was a negligible, a couple of percent of the total freight industry, we could live through the ups and downs. And if you were C.H. Robinson or anybody else, you were going to do fine no matter what. Well, now freight brokerage is about 25% of the total trucking market. And so with that level of penetration, guess what? When the market falls, you fall too. So I think that's really another layer to what's going on.
Yeah, it is. And along that same point, um, I've spoken to those and I kind of think that there's some merit to this, that part of the reason that we haven't seen um, as fast a decline in capacity or as big of an exit, and I know there's a couple different reasons for that, but one of those would be the proliferation of the brokers, right? And the technology that they've brought to the table over the last 10 years makes him a very viable service option for the large companies who, like you said, 20, 30 years ago would drop them into grease really quickly to keep the enterprise carrier on them. Well, now that service difference isn't really there, right? Is that a portion of it?
Definitely, definitely. I mean, right. It used to be that freight brokers were like the either the scrappy upstarts or the solution for just a small piece of the market. And guess what? As
Yeah,
freight brokerage has matured and as the expectations of shippers has matured and people have come to realize the value that they bring, yeah, that growth in outsourcing, and that's the other thing that's worth mentioning. Outsourcing as a category has also gotten so much bigger. So if you think
right.
about it, not to nerd out, but you and I were talking about guitars behind us and other things behind us. I got some books behind me that one of which is about um, it's a book called Outsourcing the Corporation by Hamill and Prahalad. That book came out around 33 years ago, and it was based on the premise that, as Jack Welch said, your back office is somebody else's front office. So somebody else
Mm,
is going to do a better job at the thing that you don't really care about. And that led to
right.
outsourcing everything, IT, HR, and of course also logistics. So people have now gotten used to the fact that the guy who's doing truck brokerage for you, he's not just a guy that might be a fallback. He might actually be better at it than the people in your organization if you're an enterprise, because it's not your core business, right? If you're a manufacturer, your core business is what you make or what you brand, not the logistics associated with it. So why not outsource it to a specialist? So I think that mentality has really taken root over the last 2 decades. And that's part of what's allowed logistics to become so successful, but also such a big part of the market that it's a subject to the cycle as well.
Yeah, it's really interesting to see because, I remember back in my roadway days, which was right after deregulation, one of the differentiators that we had was we would actually put an employee on site with a big enough company. And that was kind of that was kind of our TMS of the day, right?
Yeah,
It was
yeah.
a guy with a cell. Well, he didn't even have a cell phone. He had a phone and a fax machine, right? Is what it was back in those times,
I,
and that
I
was your
gotta I
TMS.
gotta ask you about that, Michael. I mean, first of all, there's no way you're that old because
I am.
you are. All right. Well, whatever you it must be the guitar. So keep doing it.
Well, it's the guitars. Yeah, it's yeah. I mean, musicians can be well pickled. It can be done. Yeah, no, I've 36 years in logistics. I've got. So yeah, I've
Excellent.
been around it a little bit. Um, but yeah, the guitars. And you got one back there. What is that guitar, by the way? Is that an acoustic or electric? What is it?
Well, I've got two. I mean, the electric is a Fender Stratocaster,
Oh,
and
nice.
you probably got one of the. It looks similar. What do you have behind you?
I got a Stratocaster right here,
There you go. That's what I thought.
blacked out, and I got a Telecaster over here.
Excellent, excellent. Well, my guess is you'll play both of them better than I will because I took it up late in life, and I've been on the DL for the last year with an elbow injury. So uh,
Ooh,
we'll save the jam session
yeah.
for some practice time.
Yeah, my best jam sessions are with the turned up stereo and a beer and maybe whiskey. That's it.
Well, it's too early for that.
Yeah. Oh, yeah. Wait, it's way too early right now. So let me ask you this about nearshoring, et cetera, and what's going on. So when before the in 2018 or the beginning, the Trump trade wars, et cetera, right? It was interesting to watch, Cambodia become the Christmas-like capital of the world like overnight, right? Is that sort is that sort of thing occurring through Mexico? And if so, or if not, how does that affect the wild swings in inventory, et cetera? Theoretically, you would not have to have a 6 month, order or booking of containers to get your materials from Mexico, and therefore there should not be these wildly off target inventory purchases.
Yeah, well, I think, Michael, there are a couple of parts to that. One is, yes, people are shifting their manufacturing from China to wherever else they can go, whether it's Mexico or Malaysia or somewhere else. Problem is that's easier said than done, right?
Yeah,
It's not like the stock market, like you're going to sell Apple and buy Microsoft or something. It's a multi-year process to shift
yep,
manufacturing and shift supply chains. Number one, and then number two, some of these markets are just too small. I mean, I remember talking with an institutional investor about this and said, well, won't this just be great for the supply chains of markets like Vietnam because people will shift? And I said, yeah, sure. But do you know how big the economy of Vietnam is versus China? I mean, I
yeah,
think it's less than 1/100th. And so you can't just automatically shift industrial capacity like that. So number one, that does add volatility, right, as you point out, because it's not so easy and it adds complexity. And then number two, remember that uh, we, for the last 40 years, supply chain professionals have been saying, reduce your inventory, run lean. Lean supply chains will help you, leverage supply chain expertise to make more money. Well, we all saw during COVID the trade-off between just in time and just in case, and so I think there's been this kind of swings, pendulum swing back and forth between too little and too much, and then back in the other direction. And I think companies are still feeling that out. The last thing that I'll say is um, that got to be so bad that there were companies. I mean, for example, major retailers, companies like American Eagle and
mm,
Home Depot buying their own supply chain capacity, whether that was
right,
acquiring logistics companies or buying ships or otherwise. Now that doesn't make a whole hell of a lot of sense in the long run, but in the short run, when you're feeling all this pressure because of shortages, I get how those kinds of decisions could get made. I think you're going to see a lot of those decisions get unwound over the next 2 to 4 years. But coming back to the
yeah,
core issue that you raised, yeah, I think we're going to have more volatility and more shortages, until people sort of find where they want to be in midst of that pendulum swing.
yeah, yeah. I believe JB Hunt got a nice fire sale on some intermodal equipment from a major retailer
Yes, yes,
in recent history.
that's right.
Yeah, good for you, Shelley. Uh, yeah. So let me ask you this: as you look forward and you're in your advising investment, et cetera, how much does you talked about it before, and it with Jack Welch, your front office, somebody else's back office, or your back office is somebody else's front office is actually how it goes, right? But so let's apply scopes of emissions to that and sustainability. How important is that becoming in your estimation, looking at companies that you would invest in as new companies or advising those that exist? Is this a topic that comes up, and how much weight is placed on it in those inner conversations?
I mean, sustainability comes up a lot more in discussions, for me at least, in Europe and Canada, than it does in the U.S.
Uh-huh.
Not that people don't care, but it's a question of priorities, right? I mean, do you believe in sustainability? Like, who in their right mind wouldn't say yes? Then the question is, okay, how much are you willing to pay for it? And that's where things get interesting.
Yeah.
I do believe it's possible to have both, and I think that's part of the premise behind some of these supply chain technology companies that can both make money and also make supply chains more efficient. And whether that's in kind of traditional areas like freight brokerage, I mean, let's face it, if the average truck, if truck utilization is basically 60%, which means 40% of all truck miles are empty, A good logistics company should be able to squeeze that out and help, on the one hand, make money for themselves and their customers and their carriers, and on the other hand, reduce the empty miles, which should be good for sustainability, right? That's kind of a conventional way of thinking about it. Then there are other ways. I mean, we have a company called Reverse Logics, which is really software that specializes in returns management. Well, that's a big deal
Hmm.
for sustainability because if you can make returns more efficient, that means that number one, less gets landfilled, right? Less gets trashed and all the sustainability harm that flows from that. Secondly, you ought to be able to make more money, right? I mean, the logistics company, in this case, Reverse Logics, the returns management software helps take labor out of the process, makes supply chains more efficient. Think of it as like a WMS for returns. So it makes labor more efficient. You have a more organized way of processing returns. That's great if you're a 3PL like a FedEx or a brand like an Amherst Sports or somebody else that's using that. And then it should be good for the consumer, for you and me, because it should mean that either costs come down because there's less waste in the supply chain, or maybe we don't have to buy as much stuff that doesn't get used. I mean, it should be good for everybody. Reverse Logic is just one example, but there's some great companies that allow you to use software to make the world better and also make money. I mean, you should be able to do both.
Yeah, yeah. Interesting. So, Ben, what are you looking for now? I've got a lot of people that are. Well, let me ask you this: what are you looking for now? But or what do you think the market looks like now? Where is it going? Because there's this now kind of softening in LTL that has been fairly recent in my discovery, talking to LTL people as seeing it. And usually that's one of those things that say, oh, this trough's pretty sticky when that hits, right? But you're starting to see upward trends. Are you seeing the same thing in LTL, or do you pay attention a lot to LTL as a kind of a gauge as to where everything else is?
I do, and also, I mean, look, I was involved in the beginning of XPO. I mean, we worked with Brad Jacobs, helped him develop the plan, co-invested with him in the acquisition of Express One that became XPO, and so yeah, I'm still a shareholder and still have a stake in the success of XPO as well as its derivative businesses GXO and RXO and then look also Rob Estes and the folks at Estes Express who we
Sure.
think very highly of and spend time with and so the short answer is yes, I do pay attention to LTL. I think there's look, clearly last year was an amazing year for the LTL category, but primarily it's because of Yellow. I mean, it's sad to say, you're where you started your career, with the guys at Roadway. When Yellow went
Yeah.
bankrupt last year, all that capacity, it really did three things. One is took out a lot of low cost freight. Two is a lot of volume shifted, and then three is it created bargaining power for for really what's now an oligopoly of the handful of majors in LTL. And so
Yeah.
if you look at the stock market, that was the best performing category in logistics last year, and LTL as a category was up about something like 60%. So now it dropped by a meaningful amount last month. So we have an index. So BGSA, our investment bank, puts out a monthly index, the BGSA Supply Chain Index, and it dropped last month, with the biggest contributor to that drop being the LTL basket. And so, look, but again, I think some of that's pendulum, right? Maybe some freight's getting repriced and some things that if you were a shipper and you were using Yellow and it was, last summer or fall, you were going to pay whatever it took to make sure that somebody else stepped in to move your freight. And so
Yeah. Yeah.
maybe some of that's just
And a
market.
lot of those were probably what we used to call poorly priced freight because you weren't allowed to call it ugly freight.
Yeah, that's right. It's
But yeah, because it's kind of when a truckload starts to shrink, there's usually a boon in LTL because you start getting those spot market volume contracts and two or three, four, five, six pallet shipments and so on and so forth as the economy starts to slow down and hits a truckload. But on the reverse side, when we hit the massive straight up a cliff to the moon increase in truckload right after, spring of 20, uh, it did the same thing. It'll do the same thing. Those volumes will start bleeding over into LTL. And if you're not a sharp LTL pricing analyst, you can lose your shirt on those volume spot market contracts because they're not there to increase volume. They're there to fill space
That's right.
and pay for fuel, right? So it's a different
Exactly.
story. Your portfolio did quite well. Is that because you're a good guesser, or was the companies you involved in, did they do something special? Where they what did they do that you can share through this downturn and trough that made them more resilient?
Well, I think there are different stories in different cases. For Reverse Logics has really built a business that is the market leader in returns management. And if you think about it, you've got a TMS, a WMS, an OMS. Over time, we believe you're going to have an RMS, returns management system. So they've
Ah,
built the software to do that end to end, and that's tremendously valuable and compelling, whether it's for a logistics company that can manage returns for their customers, or retailer or brand that has the pain point of these returns that they want to reduce, or otherwise. So I think, for Reverse Logics, it was a function of continuing to focus on doing one thing really well. Same thing with green screens. I mean, that one thing is AI for predictive pricing in trucking, and particularly for logistics companies. And so they've now got $25 billion of freight flowing through their system. And AI is one of those things that everybody likes to talk about, but not everybody knows what it actually is. And what it actually
right.
is a data model that, when you train it with more and more data, it gets more and more powerful. And so Greenscreens has $25 billion of freight, training that data model to get better and better at predicting what the cost should be, for a truckload of freight that gets shipped. And so again, specializing in something, doing one thing really well, that business, more than doubled last year. And again, because I think they're solving a real problem, a real pain point that people have. And I'll give you a third example. I mean, and you can look across, the whole portfolio, there are different areas. In tech-enabled logistics, we have a company in Latin America called Lift It. And Lift It, look, tech-enabled logistics is something we've seen lots of in the U.S. And you could say that companies like Coyote, Coyote was a pioneer in tech-enabled logistics, and of course did tremendously well. There haven't been as many in markets outside the U.S., although that's changing. Liftit really has emerged as a winner in tech-enabled logistics, particularly for middle mile and last mile in Latin America. And so, we're talking about cross-border. Well, in Mexico, Colombia, Ecuador, they're a market leader in multiple markets, throughout the region. And for them, part of it was bringing top-tier qualities, capabilities, and service levels to a market that doesn't have that many other companies that can perform at that level. That help them separate from the pack and helps them win some of the blue chip customers in that market. So in the end, what do those three things all have in common? They're totally different businesses, but they all exhibit niche leadership in their specific fields. And I think that's, by the way, one of the things that I learned from XPO and from Brad Jacobs is, Brad was really good at trying to focus on who's the best in one particular area. When you looked at the acquisitions that XPO made, they were consistently targeting someone that was great at one thing. They didn't buy the guy that was doing five things and was pretty good at all of them. It was, no, let's
Mm,
buy New Breed because they're amazing at contract logistics for tech and telecom, right? Let's buy the Conway business because they're a market leader in LTL, or Menlo in contract logistics and in their arena, or Pacer in intermodal. And so picking leadership niche by niche is something that we've really tried to do. And that's what we look for when we look for new platforms.
excellent, excellent. So, Ben, what can you share with us on your thoughts as we go through 2024? You see the trough on an uptick here by the end of the year, or next year, or what do you think?
I think we've hit the bottom. I think things are starting to get better already. I think it's a question of how long and how fast. I mean, the joke is that people have been saying we're 6 months away from recovery for for 18 months. Um,
Yeah.
so
And fusion is the energy of the future, and it always will
exactly.
be.
Just keep repeating it. That's right. Exactly right. If you keep repeating it, eventually you'll be right. So
That's right.
I do think we have hit bottom. I do think that the data shows that, again, pricing is starting to improve, capacity is starting to tighten. I think all that's good. But look, I also think, I mean, for me, you know, Cambridge Capital invests across all areas of supply chain. So while we care about freight, and of course, multiple companies that are tied to, the freight ecosystem, we have companies in different areas as well. Reverse Logics, is really independent of the freight cycle. Reverse Logics is really more a function of the fact that as more and more people buy things online, the pain of returns gets higher and higher, and the desire to get it right gets to be more and more significant. Similarly, we're announcing a new investment tomorrow, and it's a company that helps brands reduce the fees that retailers charge them. So, for example, if you were P&G or some other major brand and you do business with Walmart, if you don't deliver on time and in full, you get charged an OTIF fee, an on time and
Mm-hmm.
full fee. Well, those fees add up. I mean, for Walmart, those are over $2 billion a year. And think about that across all the other retailers. And so, you're dealing with a market that's in the tens of billions, worldwide. It's a big problem. So we just invested in a terrific company that focuses on helping brands reduce those costs, make their supply chains more efficient, and reduce the fee exposure associated with that. Great business doesn't have anything to do with whether freight is up or down. It's more about solving a problem. And I think, for us, the main idea is if you back great people who are solving real problems, then the freight cycle shouldn't be, shouldn't be that big a deal, whether it's on the upside or the downside.
Yeah. 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 You gotta hedge, so to speak, I would imagine, right? Kind
Yeah,
of.
exactly.
Yeah. Excellent stuff. Ben, I appreciate it so much being on the show, man. If you're not listening to Ben, I don't know who the hell you're listening to. I do. I follow him on LinkedIn. You can find him there. Where else can people follow you, Ben? And who should be reaching out to you?
Well, you can find, as you said, LinkedIn handle is Ben Gordon 18. Twitter handle is Benjamin H Gordon. You can certainly go if you go to the Cambridge Capital site or BGSA site. There's lots of content there as well. And in terms of who, look, I think uh, we love talking to and working with great CEOs building great businesses in all areas of supply chain. So wherever that is, whether that's truck brokerage or freight forwarding or warehousing or supply chain technology or asset side or non, you name it. If you are building a great business in supply chain, would love to talk with you. Cambridge generally invests 10 to 50 million in companies. If they're in software, they're generally doing 5 to 20 million of revenue of ARR. If they're services companies, generally 5 to 20 million of EBITDA. But flexible on size, as long as you are doing something great, we're interested and would
You're
certainly.
looking you're looking for startups and that type of stuff as well. Or are you already established?
Well, it's a combination of growth and buyouts. Startups that have
Gotcha.
something great that already have some major customers and 5 million plus of revenue, great. Startups that are just kind of early in their beginning, that are more seed stage. Love those guys. We love to give them visibility. We have our annual conference, the BGSA Supply Chain Conference, where we give companies the chance to participate in the Shark Tank competition. And so, guys that are building something great that are earlier than 5 million of revenue, while Cambridge may not be the right investor, we're glad to give them the opportunity to get some visibility, through the conference. But what we're
Love it.
generally investing in is later stage.
Ben, awesome to have you on. I really appreciate, my friend. Everybody, thank you for watching FEI Freight Executive Insights. We'll see you next time. Peace and love, everybody.
Thank you, Michael. Great to see you.